Hi everyone, it's Bruce Firestone here. And what we're going to do today, and what I hope will be a short video, is we're going to see what you should pay for investment property. And I've said many times, and people who followed my writings and my teachings know, and the coaching that I do know, that I believe you make money in real estate when you buy, not when you sell. And in fact, I teach people to buy and hold. So buying smart, buying properly is really important. So here's an example from last week when a client of mine is looking at buying a small boutique hotel. We're going to call this hotel the Sanctuary, which is not its real name. You see it on the screen there. And I've changed the numbers a little bit just to protect identity. So the list price on it is $1.85 million. It's in a tourist area, it's in a ski area, and it comes with land of about 2.6 acres. So I think that's about a hectare if you're from Europe or you're using the metric system. It has 9 bedrooms, so it's a true bed and breakfast hotel. It's not an Airbnb. It's a place where you have an owner on site or manager on site and staff on site, and you're providing services. So it has 9 bedrooms that they rent out for $200 a night, and the average occupancy over the year is around 55%. Now, if any of you guys who are watching this know something about hotels, motels, even Airbnb, when you get to sort of a 70% occupancy, and certainly at 80%, but anything over 70, you typically are making decent amounts of money. At 55%, that's a little bit below the line, so not a particularly strong occupancy rate. So if you want to find out, and you'll see on the screen, I hope here in a second, how to find your gross operating income, your GOI, you simply take, and if I click in here, I think it'll show me, yeah, you simply take the bedrooms, multiply it by the occupancy rate times the rate per night times 365 days per year. You hit enter and you get gross operating income from this particular listing of $361,000 a year. Typically, when you're operating sort of just you bought a duplex or something, your margins are around 0.66, which means that about 34% of the money you collect, your gross operating income, is used for insurance, property taxes, repairs, maintenance, vacancy allowance, everything except your mortgage. But when you're operating a hotel, even a boutique hotel like this one, your margins are quite a bit lower. So I put in 0.45. So I reconstructed the net operating income to be simply, if you just look at this again, I'll highlight it for you. The gross operating income times your margin and hit enter again gives you $162,000 a year, assuming that you have no mortgage on it, right? So this is as if you had paid off your mortgage. What is your net operating income? Well, that's what it is. Cap rate then is very easy to calculate. It's simply, if you bought it for the list price, 1.85 million, simply net operating income divided by the list price. And I'm ignoring transaction costs. You know, if you have to pay a lawyer to or notary or wherever you happen to be, you pay some additional closing costs, welcome taxes in Quebec, in Ontario, land transfer tax in the United States. There's all kinds of things as well. So you have some closing costs that you have to take into account, but we're not doing that here. So it means that you end up with an 8.8% cap rate going in. So if you paid the full list price, and these are the kinds of incomes that you would generate, you would have an 8.8% cap rate. Now, probably in most cities and towns in North America and Canada, the United States, if you bought a single family home and you got a 6% cap rate, you'd probably be happy with that. You know, in some towns like San Francisco and Boston, Portland, Seattle, and Toronto, Vancouver, these are expensive cities. Your cap rates may be much lower than that, might be 3 or 4%. So not really good. So I set a target for cap rates of, and I'll just put it in here, of 6% minimum. All right. So I wouldn't be too interested in any kind of you know, any kind of an investment that produces less than that. All right. But 8.8% is considerably above that. But this is a commercial investment. There's a lot of work involved. It's like you have a full-time job, maybe more than a full-time job. So I don't think that's appropriate. So my client and I discussed what their target cap rate would be, and he would like, and he and his spouse would like 11.5%, which I think is reasonable. So when you're buying property that's not located sort of inside a busy urban area like the towns I mentioned, cities I mentioned a few seconds ago, 6% is probably okay because in addition to that capitalization rate, the cash return you're making, you're having some kind of an appreciation. You hope the real estate's going up in value every year, and you also have a wealth effect from paying down a mortgage if you have a mortgage, right? Your tenants are helping you pay that. But if you're buying rural property or property that is like this, it's in a tourist area, you need a higher cap rate, in my opinion, and a minimum is 10% and preferably 11 or 12%. So we put in 11.5%. Now, what should his offer be? Then what should his purchase price be? So that's very easy to figure out too. So you take this reconstructed net operating income, you divide it by the target cap rate, and you get 1.413 million. Right. So what I said to my clients last week was, don't pay more than 1.4 million for this. All right. Then going in, you're going to get an 11.5% cap rate. So you would think that's the end of the story, but it isn't. So I'm going to show you another spreadsheet I prepared for you guys. So this is the Sanctuary Hotel cap rate analysis, but I'm going to call this the animated version, and I'll just put that in italic. So it's kind of like case two. All right, I better save it too, just in case something happens. So again, we see the list price was 1.5 million. It's a 2.6 acre site. Same thing, same analysis down to the recommended purchase price. But for those of you who've been following the work that I do, I really like this glamping model. And in fact, one of my former architecture students, I used to teach architecture design economics to architects at the Israeli School of Architecture and Urbanism at Carleton University. And so Anissa Zato, she actually, with her crew, they build these yurts, which are kind of what the Mongols use for thousands of years to live in, and she calls her company yurta.ca. So it's a Canadian company. I think it's headquartered in Pickering, Ontario, and uh, and she builds these wonderful yurts. And you can see on the pictures here on my screen, they're good down to minus 25 degrees Celsius. So you can use them year round, and they can sit in the middle of nowhere. You can have lots of windows. You can see that on this picture here. You can attach a WC, that is a water closet or bathroom and a shower too. So you can really create a great glamping experience, glamorous camping. So I said, what if my clients bought this place, hopefully around the $1.4 million mark, and then bought 6 of these yurtas from Anissa Zato's organization. They're really great. We bought 2 of them, by the way. And it costs about $40,000, and the $40,000 is not for the yurt. The yurts are much less expensive than that, but you have to build a deck. You have to furnish them. You have to put a wood stove or a propane stove or a gas stove, natural gas stove inside for some source of heating. So I'm estimating about $40,000 all in. So if you bought 6 of them, it's very simple to see. That would be 6 times 40,000. Hit enter again, you get 240,000. Now your total cost for your hotel with the glamping opportunity or option is the total of these 2 numbers here, right? Okay, so that's what you get. So you get $1.6 million, which you'll see again when I highlight it. It's just the sum of those 2, 1.654 million. All right. Now the gross income of yurts, this is incredible, really. If you charge $185 a night to stay in your glamping yurt, and you have the same occupancy as the existing business, which you would hope you could increase and improve, but you're going to have a better margin, probably more like a residential margin. You're probably going to have a 0.66 margin. So it means that your gross operating income, again, just highlighting that, is 6 years times $185 a night times 365, somewhere in there, yep, times 55% occupancy, hit enter again, you get 222,000. Your net operating income is simply the multiplication of the gross operating income times the margin, so it's about $147,000 of gross operating income. So think about this. This is an animation, right? a way to increase your revenues. You invest $240,000 in these yurts, and you add $147,000 of net operating income. It's as if you bought a house for, say, $240,000 in Atlanta, and you were able to rent it out for $147,000 per year net, right? That would be pretty cool, right? It would be amazing. Let's buy lots of those if we can find them. So that's what the yurts can do, I think, and glamping can do for this site. So the total net operating income is simply the income that you get from these yurts and the income you got from the boutique hotel. So it's now $309,000, almost $310,000 per year, and your cap rate has gone up incredibly to, to what is it here? It's 18, almost 19% per year, which is truly phenomenal, right? That is fantastic. So now the question is, what is the right price to pay? Maybe you could pay a couple of $1,000,000, right? And still make money. That's the wrong way to think about price, right? You are doing all the work to raise the occupancy rate, to put the yurts in, to add glamping, to add some other animations to this property. So you should benefit from that, not the seller. It's your work that's producing this additional income. So I would maintain, even if you feel that you can get a cap rate which would be as good as this, which would be fantastic, 18.7%, you still should only pay 1.4 million. Now I want to show you something else, and this will be the last thing I do on this video. What if you said your target cap rate for this hotel, boutique hotel, was 6%? So I'm going to change this number. I put 6 in here, and I hit enter. It means that you could overpay for this. And obviously, I don't want to do that. So if I hit Control Z, it just simply resets it right to the original numbers. Sorry if I went too fast for you guys, but you can always replay this. And thank you very much for watching.